Hi, thank you all for joining the Investing in Blockchain conference call. For those of you who are new to the firm, I want to give a bit of a background on these types of calls. You know, we're evangelizing a new asset class. We want to be sharing as much information about the space as we can. So we do two different conference calls each month. This one is kind of the general overview on why blockchain is interesting and how to get invested in the space. And then we also have a very specific call that we do once a month on our new blockchain fund that we're in the midst of raising for. On the next slide, we have just an agenda so you know what we are going to be talking about. I'm going to be joined by our co-CIO, Joey Krug, and then our director of platform, Franklin B, will also be joining us. We do have the full investment team on the line, so if you have questions, feel free to use the Q&A box. We will answer questions as we go. Love to take any range of questions, about the markets themselves, specific tokens, and then obviously our funds if you have questions about the funds themselves. For some of you are already LPs in some of our funds, but for those of you that don't know much about the firm, on the next slide we have an overview of the firm itself. I founded Pantera in 2003 after I left Tiger Management, and for the first era we managed $1 billion of very normal hedge funds, but in 2011 I got interested in Bitcoin, and we launched the first crypto fund in the United States, and have launched some various other products to give exposure to the whole spectrum. The funds have been very successful. Partly it's a testament to how fantastic our team is, and partly it is a function of what an amazing asset class we're in. On the next slide, we have a overview of the firm. We're currently managing $5 billion. We have 4 main strategies. We've invested in 80 different companies over the years and 65 early stage tokens. And one of the best examples of why this is such an amazing asset class to invest in is in those 4 strategies, we've had a couple of different iterations, 3 different venture funds and a few iterations of our early stage token funds. And we've invested sometimes at the absolute peak of bubbles that burst, and our Bitcoin fund we launched on the absolute low of the last 9 years. So we've kind of caught the whole spectrum, and even including all those ups and downs, the average of 8 years of investing has been 104% IRR. And again, a lot of the credit goes to Paul and Joy, my main partners, and the rest of the investment team. But part of it is we're just in such an amazing space. And I think this space is going to be as asymmetric and as dynamic, maybe for another couple of decades, but probably another decade. And I want to give a little context to the history of the firm's fund launches. As I mentioned, we launched the first cryptocurrency fund in the US in 2013. We also launched the first blockchain venture fund. And kind of as a historical legacy of that, we ended up with 4 totally separate strategies. And that's been great for investors that want very specific risks. Many institutions come at blockchain from the venture side first and want venture only. So that's been great for those institutions. And then on the flip side, some people want a lot of liquidity, and our hedge funds have very, very high liquidity and no lockups. So those 4 funds span the entire spectrum of assets that you can invest in. And on the next slide, we have a visual representation of all those different assets. In our current fund structure, with the exception of Bitcoin, any new asset can only go in one fund. So if it's equity, it has to go in the venture fund. If it's an early stage token that's not yet trading, it has to go into the early stage token fund. And if it is liquid, it has to go in the liquid token fund. And as I said, that's been great for people that want those very specific risk buckets. But many investors, particularly endowments and other institutions, want to allocate to the concept of blockchain and then let their managers sub-allocate between all those different asset classes. And so this new blockchain fund that we're in the middle of fundraising for now does cover everything that we currently do. And with that, I want to hand it over to my partner, Joey Krug, to explain why we think this is such an amazing opportunity.
Thanks, Dan. So At a very high level, the way we would describe our thesis is that cryptocurrency and blockchain tech is the underpinnings or beginnings of a new financial infrastructure, similar to how the internet did the same thing for information. So, the internet changed how information was consumed, but also how it was created. And I think the same thing is going to happen here, but for finance. And so if we look at the history of the space over time, there's really three main evolutions, I would say. So the first one is looking at Bitcoin. Bitcoin enabled, decentralized global peer-to-peer value transfer. And the main problem it solved was called the double spend problem. So it's how do you send money across the internet without, counterfeiting the money? If I want to send Dan a payment, how do I ensure that I only can send the payment to Dan and I can't also send the same money to Paul, and then one of them gets stuck with, effectively counterfeit digital money? And Bitcoin solved that problem, so you can only send it once. You can't double spend. Not a lot happened after Bitcoin was created until Ethereum came out. And when Ethereum launched, Ethereum added a really interesting idea on top of Bitcoin. It basically added the idea of, what if you add programmability on top of the money? So what if you have the ability to add, if this statement's true, the money goes to this person or it goes to this contract. Otherwise, if this other statement's true, it goes somewhere else. And if you think about that kind of really simple logic, you can pretty quickly create very complex financial contracts and agreements. If you think about most things that happen on Wall Street today, they're really just really complicated, glorified if, then, or else statements. And any sort of financial contract or agreement has a bunch of these in it, a lot of legalese. But if you look at Ethereum, the idea is, what if you actually just made this computer code or software? And we'll talk about some of the use cases in a moment, but that concept is known as smart contracts. The main drawback of Ethereum, though, is it's not very scalable. So, if you want to do a transaction, it costs quite a bit of money. Ethereum transaction might cost anywhere from on the lower end $20, on the higher end, a few $100s, because the throughput, the number of transactions you can do per second, is anywhere from 10 to 20 per second, depending on the type of transaction you're doing. And the number everyone loves to compare to is Visa. That does about 2,000 transactions per second. If you look at exchanges like the NASDAQ, they do a few hundred per second. And so you need higher than what Ethereum supports today to actually have financial use cases at scale. And so there's a few different solutions to this problem. One of them is, launching other blockchains like Polkadot or Solana. The other, though, is what are called layer twos, or basically building systems on top of Ethereum that enable much higher scale and much higher, transaction numbers. But if something goes wrong, you can fall back to Ethereum as sort of a safeguard or fallback. And we're actually seeing that today. A bunch of those have went live recently. Projects like Arbitrum or Starkware. Arbitrum actually went live about a week or two ago. And so if you look at what's happening in this space, the most interesting area we think is what's called decentralized finance. And I think over the next 5 to 10 years, this is going to be a massive area. And I think more and more the current kind of legacy financial sector is going to port over to DeFi. And so if you look at the 5 components that are necessary, the first one is you need a unit of account to denominate trades in. For global trade today, that's predominantly the US dollar. And it's actually no different in crypto. In the early days, people denominated trades in Bitcoin, but at this point, most people are trading based on stable coins like USDC or Tether. And DeFi, people are using DAI, USDC, and to some extent Tether, but it's mostly USDC and DAI. Then you have exchanges that allow you to trade assets with no intermediary. These are things like Uniswap or 0x that let you basically, trade one cryptocurrency for another. Today, they're predominantly cryptocurrencies. There's a few people who've launched like synthetic assets, things that are pegged to real world assets, like a synthetic version of Tesla that trades 24/7 on the blockchain. But there's not a whole lot touching the real world yet. I think that's going to be, 5+ years out. Right now, most of the things in DeFi that are happening, specific to crypto. Next, you have lending and issuance. These are things like Compound, MakerDAO, protocols that basically let you borrow or lend out other cryptocurrencies. And the last 2 components are margin and leverage. In the early days of DeFi, margin and leverage didn't really exist. It's kind of somewhat difficult to do on chain because you need the ability to liquidate people if the price of the asset they're borrowing against starts to drop. But people have solved that problem by now. There's a lot of systems that use margin and leverage, everything from MakerDAO to DYDX. UIDX lets you basically get leverage if you're buying or selling something like ETH. And so if you look at the ecosystem, the way I would think about it is you kind of look at what's called the tech stack. And so at the very bottom layer, you have the actual blockchains themselves, Bitcoin, Ethereum, Polkadot, newer chains like Near and Cosmos, where people are building, smart contracts on top of them. One layer above that, you have what are called oracles. These are things that get data about the real world into the blockchain. I'd say the most popular one at this point is Chainlink. People predominantly use that to get like data really quickly. If you have data that's like you need, on a block by block basis or every few minutes, Chainlink is what people predominantly use in the space for that. And then one layer above that, you have some of the protocols we talked about on the last slide. Lending, decentralized exchanges, marketplaces, payments, synthetic assets like Mir. And I think synthetics are going to be an area that sees a lot of growth in the future, just because of the fact that there are things that actually touch the real world. And there's actually a lot of benefits of having them on chain, like you can trade 24/7 and it's global. And if you go layers above that, you have protocols that kind of use different components. Like decentralized derivatives exchanges often use, lending protocols as part of them. And then also they're obviously an exchange as well. If you go to the very top, you have aggregators. Some people still access, these protocols via their own UIs. Like if you go to Uniswap, you can access Uniswap directly via the Uniswap UI. But if you're trying to do a trade, you actually really just want the best price across any decentralized exchange. You don't really care whether it executes on Uniswap or not. You just want the best execution. And so there's things like 1inch and Matcha that basically you go to them with the order you want to do, and they give you the best price by calculating kind of what's the optimal way to split your order up across multiple dexes. And there's similar things for borrowing. Things like InstaDApp actually allow you to refinance your loan in DeFi to get a better rate. And so if you look at the growth that's happened in DeFi so far, the amount of value locked up in DeFi protocols is now over $165 billion. And a year ago, it was a much smaller number. It was in billions, but at least 10 times lower. The other kind of interesting metric to look at is trading volume that's happening on decentralized exchanges. This has been a bit less parabolic recently because as the markets kind of cooled off this summer, volumes on exchanges dropped. They dropped on both centralized exchanges and decentralized ones, but they're starting to pick back up. If you look about a year ago in September 2020, DEXs did about $31 billion in trading volume. Last month in August, they did about just under $80 billion in trading volume. So still over 2x growth in a year. And I think as the market continues to rebound, I think volumes will increase as well. Now Franklin's going to talk a bit about other areas in the market outside of DeFi.
Thanks, Joey. So another area that we've seen a lot of recent growth from, and definitely a lot of media headlines around, is non-fungible tokens, or NFTs. NFTs you can think of as sort of a richer file format compared to the typical crypto asset that we're used to seeing that looks more like a commodity, in the sense that NFTs have a number of more data fields that allow us to capture a much more extended universe of assets. So you can think about sort of the difference between having a REIT or an ETF versus capturing a specific real estate property or a specific type of financial instrument, whether that might be an option or an exotic derivative or something like that. With NFTs in particular, a lot of the focus has actually been around the creator economy. So digital artists issuing NFTs that are meant to represent ownership of a particular piece of work that they've created. In the past year or so, we've seen sales volumes for NFTs actually grow quite exponentially. In the first half of this year, there was around $2.5 billion of sales volume. In the month of August alone, there was $3.5 billion. So we're definitely seeing a lot of attention here. And, one of the kind of narratives that NFTs really share with the rest of the crypto ecosystem is one of decentralization. right? The fact that there are a lot of intermediaries that play a centralizing role in industries like music, art, gaming. And so the ability for creators to have a direct relationship with their fans and their users actually opens up a new revenue stream for them that they can have a greater amount of control over. So we're looking closely at this space. We recently led an investment into a leading NFT marketplace called Maker's Place. And we're going to continue looking at the NFT space as one of the most exciting sort of new design spaces that creators and entrepreneurs can really start to focus in on now. So in terms of the rest of the ecosystem that we're really excited about, a lot of the trends that we're seeing are around infrastructure, both on the financial side and the developer facing side. So developer tools, infrastructure, scalability solutions that help builders build more easily on blockchains. So one of the leading players here is one of our portfolio companies, Alchemy, which we can think of as sort of the Amazon Web Services for crypto. Alchemy gives developers the ability to develop decentralized applications much more easily, run the node infrastructure that's required, manage the smart contracts, debug issues when they need to. And we think that that's a huge sort of unlocking set of tools that help speed up innovation in our space. On the financial infrastructure side of things, it's a lot of familiar sort of fintech business models that we've seen over the past few years. Payment processing, where companies like Veeam have developed a B2B payments platform that runs on crypto rails, among other payment rails, and helps facilitate direct B2B payments for a more efficient method of transferring value. Exchanges have also been a huge part of bringing mainstream users into the crypto ecosystem from traditional banking. Exchanges like Bitso, the leading platform in Mexico, are helping to facilitate the transfer of cross-border payments, sometimes as high as up to 7% of all remittances between the US and Mexico traveling over Bitcoin payment rails. And we think that's a trend that's going to continue, where cryptocurrency exchanges really provide the on-ramp to an alternative financial system that's more efficient and more real-time. Then in terms of other sectors, in enterprise and consumer, we're seeing that there are non-financial applications as well. Companies like Chronicled that are focused on the healthcare industry, providing a blockchain-powered network for transferring data and tracking the supply chain for things like pharmaceuticals. And on the consumer side, Maker's Place being the premier NFT market, as well as companies like Staked that are helping institutions and individual investors to manage their portfolio of staked assets as part of their overall crypto portfolio.
So one of the themes we've been very big on for the last 12 months is tokens that are not Bitcoin and Ethereum. And so for a long time, Bitcoin was a great proxy for the entire industry. 100% of my risk was in Bitcoin. And then you could have, half Bitcoin, half Ethereum. That was a really good proxy for the entire blockchain ecosystem. And in January, we announced that we thought that was no longer true, that it was time to have, a very robust portfolio of things that were not Bitcoin or Ethereum. And this is a graph of the market cap of the stuff that's not Bitcoin or Ethereum. It hit 16% in January, is now 39%. We think over time it'll keep growing as more and more of these projects build out. So now I wanted to take it back to, why now? The technology that Franklin and Joey have been talking about is being built out for the last 12 years, and a lot of really exciting things are happening. But there are a couple big things on the macroeconomic side that are making the market really just go into afterburner mode. First one is in June last year, the United States started printing more money each month than it did in the first 200 years of its existence. It's really just keeps dialing up. They're throwing around trillions now at a rate that is just staggering. And the deficit is equal each of these 2 years to $14,000 per adult in the country. So it's an amazing amount of paper money that's being printed, and its impact on prices in the world are on the next chart. This is showing the price of paper money inverted. So it's the price of the US dollar as quoted in things whose quantity you can't ease, like gold or sugar or copper or oil. So things that have a fixed amount of quantity are rallying relative to the dollar. The way to think about it is paper money is getting killed. Cryptocurrency represented here by Bitcoin is obviously doing the best, but this is a trend that I think is going to keep going for the next couple of years. That has brought in legendary investors like Stan Druckenmiller and Paul Jones that are have seen these cycles before, have seen what happens when paper money gets debased. In the past, they used to buy gold, and now they are buying Bitcoin. And it is a question I get a lot is, why is gold the least good performer on that former chart? And it is because Bitcoin and other cryptocurrencies are stealing massive market share from gold. And the next slide just highlights a huge change in kind of the corporate acceptability of cryptocurrencies. You have, very massive, important companies that are buying crypto or allowing their customers to buy crypto, endowments investing in it. And why are they investing in it? In my career, I've spent a lot of time looking for very asymmetric risk rewards, trades where you can obviously lose money. They're speculative. There's some downside, but the upside's much greater. And on the next slide, we have a visualization of that the cryptocurrency market is about $2 trillion in value. It's disrupting markets that are many, many trillions, sometimes tens or 100 trillion. And that will provide an enormous amount of opportunity. Another graphic we don't even have on here yet is the global bond market is also 100 trillion. So as DeFi goes up against existing asset classes, it will be a very asymmetric risk reward. Joey mentioned there's 100 billion in outstandings in DeFi. There's 100 trillion in bonds. So we have 1,000x that it could continue to grow. So any disruptive technology is considered, it looks really crazy when you graph the price in a normal absolute return graph. We now have it graphed here exponentially. So you can see Bitcoin's actually been relatively steady. There have been a couple of bubbles, there have been a couple of bursts, but net of all that, it has been compounding for 11 years at 233% per year. And right now, as you can see, it's a bit below its trend graph. So we think, if anything, crypto is quite cheap. The other reason big endowments and others are putting it in their portfolio is modern portfolio theory has been so successful that almost everything in their portfolio is correlated with the other things in their portfolio, and their portfolio is very correlated with other investors' portfolios. On the next graph, we have a visualization of the correlation of Bitcoin relative to major asset classes is essentially zero. That's an amazing opportunity to have an asset with a crazy compounding annual growth rate and zero correlation to everything else. That is something you want to have in your portfolio. Admittedly, 10 years from now, when everyone has a blockchain team and a blockchain allocation, crypto will be correlated with everything else, but for now it isn't. So it's sometimes unsatisfying to think about how you value cryptocurrencies. Some of the newer ones have cash flow, so you can do a discounted cash flow model for them, but many like Bitcoin are utility tokens. It's just however many people are using it. And it really comes back to essentially an Econ 101 supply and demand graph. As you have supply shocks, like last year, the number of Bitcoin issued to the market was cut in half. And then you have demand bumps, like bringing PayPal or Morgan Stanley or all these other firms into the space. That bumps the demand for Bitcoin. And as more people come into the market, it drives up the price. The next table is one of the most fascinating we've ever created. It's the number of people using Bitcoin in one column, and that's gone up 10x every 2 years for 10 years. And then on the left is price of Bitcoin. And the price of Bitcoin has also gone up exactly every 2 years. And there's only one time in 2016-17 that it didn't happen at the same time. So if we, and I've never seen a ratio that's been this steady over such an incredible growth of 5 orders of magnitude. So where could we be going? Pundits always, jump past themselves to make the crazier and crazier predictions of the future price of Bitcoin. But if everyone that has a smartphone began using cryptocurrency, began using Bitcoin, it would have a terminal value of Bitcoin at $700,000. And I actually think that's a decent number. That would represent about 15% of global M2. So that's, something that's totally doable. Okay, and the last negative that people have about crypto and Bitcoin is it's too volatile. And yes, it is volatile. You saw on that exponential graph, there's been a couple bubbles. There's been some bear markets. Some of the bear markets are 80, 90%. And you'd think after bear markets of 80%, your price would always, would be hitting new lows. On the next graph, we have the yearly low for Bitcoin, and it's only had one new low. So even with the crazy volatility, with all the, booms and busts and all that stuff, the important point is it's almost always booming to the upside. So market volatility. We have had a big burst in volatility. In May, we had the biggest, most volatile week in the history of Bitcoin. And what I would say is that presents a ton of opportunity. Luckily, we were launching the blockchain fund right then, and so we were able to scoop a bunch of very inexpensive tokens when people were panicking over China banning Bitcoin or Elon Musk freaking out about Bitcoin one way or the other. All right, so the other issue that's been prominent in the market is, and Elon Musk has been one of the main people to flip on this, is to fret about the ESG-ness of blockchain. And this graphics, one we wanted to share. It's a summation of 15 pages that we wrote in August. But the punchline is all blockchains are wonderful for social and governance. They're going to bring enormous benefits to literally billions of people on Earth. And then most blockchains don't use energy, so they're also unambiguously awesome from an environmental standpoint. And then, Bitcoin does consume a large amount of electricity. You can make very good arguments about what fraction of it is renewable and the value of censorship resistant, censorship proof money, and have an interesting discussion. But the punchline is blockchain generally, and most blockchains like Ethereum are absolutely wonderful for ESG. And that is a debate that I think will go away in the relatively near future. So one of the subcategories of the environmental question is Chinese Bitcoin mining. And this Chinese ban on mining actually is quite real. Originally, we were skeptical about it, but in our August investor letter, we put a really impressive polynomial regression of the price of Bitcoin versus the electricity consumption slash the hash power, the compute power in the network. It has an 80% R squared, so it's amazingly accurate. And this shows that the price of Bitcoin did not forecast the amount of reduction in capacity. So that is some kind of exogenous shock, the Chinese ban. And at the time, a few months ago, we forecast the gold area of that $2 billion of free money getting soaked up by miners in other countries, particularly the United States. Actually, the big surprise, a lot of that capacity is coming to the United States, and it's behaving exactly as we forecasted. Over about 3 months, all that will get taken up. Okay, so back onto now and the price. Here is a graph of the value of Bitcoin today versus its 11-year compound annual growth rate trend. We're 40% cheap to that right now. So, the obvious question I get from investors is, today a good day to buy Bitcoin? 95% of the time in the last 8 years, I said, yes, it's a good time to buy. And right now is actually a very good time. We're very cheap relative to the trend. That's unfortunately not how humans were built. We were built to be very pro-cyclical. We're very herd-oriented animal. And so we all do it. We all want to buy at the highs and sell at the lows. And this is a graph of the inflows into Pantera Bitcoin Fund, which is the oldest crypto fund. And it is the gray bars are the percentage of time Bitcoin is spent in each of these buckets, which are 33% rally from one bucket to the next bucket. And as you can see, it's pretty normally distributed most of the time right on trend, a little bit of time way far above it and a little bit of time way far below it. And the inflows into our funds are typically very light when it's actually really cheap, like it is now. It's 40% cheap to the index. And then, when it's absolutely the ultimate high and, all the Bitcoin pundits are on TV all the time talking about how wonderful crypto is, that's, when most people want to invest. So it's just a kind of a refresher to remind us all that it's good to buy when things are at the low end of the spectrum. And with that, I want to hand it back to Joey to talk about how one can get exposure to the space via our fund.
Awesome. Thanks, Dan. So if you look at the space, we offer the full spectrum of exposure that you could want, anything from super illiquid venture to very liquid daily liquidity Bitcoin. And so if we go to the next slide, we can walk through the different funds we offer. So if you look at our hedge funds, we offer 3 funds, starting with the order that they are launched. Our Bitcoin fund, which Dan launched way back in 2013, offers passive exposure to Bitcoin. It's daily liquidity, no lockup, low fees, no premium or discount to NAV. It's just the actual price of Bitcoin. You can come in and out on a daily basis. Then we launched our early stage token fund in June of 2017. That fund has quarterly liquidity with a 1-year notice, and we're investing in really early stage blockchain protocols there. You could sort of think of it like venture investing. We're looking at the same things, like really high quality team, how fast are they iterating on their product or protocol that they're planning to launch, total market size, that sort of thing. And we're investing very early. If you think about venture, we're investing in this fund, the equivalent, almost most of our deals are the equivalent of a seed round or a Series A in token projects before they go live and are publicly traded. Then the last hedge fund we launched is our liquid token fund. This fund just offers quarterly liquidity, and it's actively managed exposure to public assets in the space. So think things in the top 75 or so by liquidity on CoinMarketCap or CoinGecko. And we're focusing around the DeFi space, buying things that we think are very high quality positions, and then weighting them according to how undervalued we think they are relative to each other, and then also with the active risk management overlay on top of that. And so if we look at the performance of our funds, starting on the left with venture, our first venture fund, the current total value paid in multiple to it is about a 15.4x. Our second fund is about a 4.9x, and then our third fund is about a 4.2x. These are as of June 30th. And if you look at the IRRs, the respective IRRs are 53%, just under 39%, and then 124.9% for Fund 3. Fund 3 we raised in 2018. We just finished deploying it this year, so it has a lot longer to actually mature. So I think that final multiple will actually be much higher when we finally end up returning capital on that fund. And then if you look at our hedge funds, here we have the AUMs of each of them listed and their life-to-date returns, and then also their compound annual growth rates. If you look at the early stage token fund, it's up about 1,300% net life-to-date, with 92% compound annual growth rate. Our liquid token fund's up 416% life-to-date with a 53% compound annual growth rate. And then our Bitcoin fund's up just under 66,000% with 121% compound annual growth rate. And with that, I'm going to hand it back to Dan to walk through the blockchain fund.
Thanks, Joey. So our existing funds, do pass through the underlying liquidity of the assets, but force the allocator to pick, which of the 4 funds they want. This new fund is essentially a hybrid of a venture style fund with some features of a hedge fund. We originally set a target of 600 million That's about a 12% increase over what we're currently managing. So it should be doable. And we also try to pick a number that we could achieve without a huge amount of distraction to the investment team. We are going to have closings on each fiscal quarter end. So June 30th, September 30th, December 31st, and March 31st. We had the first closing on June 30th. We actually were able to do well over half of that target in the first closing, 375 million. We are going to be certainly having those other 3 closes. We want to give institutions time to get through their very long process. So we'll certainly have a closing at the end of March of next year. And this fund is the first fund we kicked up to $1 million minimum. All of our other funds have under $1,000 minimum because we're trying to evangelize a new asset class and try and get more people access to the space. And on the next slide, we have some of the terms. Obviously, we'll send this presentation out and go over that with anyone who has questions. But essentially, it's like a venture fund with a 10-year lockup, a commitment up front, but it has some features of a hedge fund. We will have a 5-year investment period within which we can recycle early stage token investments into new early stage token investments. But after that 5th year of the investment period, anything we sell, both venture or token, will go back to LPs. The original capital call is 25%. We're also synchronizing capital calls to be at the end of fiscal quarters to make it easier for some of our LPs that want to take profits in our existing hedge funds and move into the new blockchain fund. So we're calling 15% more capital at the end of September. So for new LPs, it'd be 40% at the end of September. And with that, I want to hand it to Franklin to explain a little bit about what his team is doing to help support companies.
Thanks, Dan. So I think one of the important aspects about the way that we view investing is just the fact that this ecosystem is really unique in the sense of what founders need from their investors, and it's an asset class where founders get to pick, right? The asset picks you. You're not just picking the asset. So one of the things that we really focus on with our edge is the types of ways that we support our portfolio companies and projects. And the way I would think about it is really that there's 2 halves to our platform strategy. One is around traditional company building type support, where we're helping our companies to hire smart contract engineers, hire executives, business development talent, and providing them access to the funnel of talent that's really coming into Pantera's network on a constant basis. In terms of supporting the team on technical challenges, Joey, Lauren, Paul have all played really significant roles in helping some of the top DeFi projects really get out to market and launch their products. And so helping to provide that type of expertise and lessons learned is a big part of what our team brings to the table. Then on sort of the other half of the way that we support our portfolio companies, it really is sort of things that are native to the crypto ecosystem. Whether it is helping our projects to navigate the trading infrastructure and exchange ecosystem that exists within the blockchain industry, helping them to connect with the right strategic partners, and also on the more decentralized side of things, participating in decentralized governance has become a really important aspect of what founders are looking for from their investors. So, our aim is really to be able to be helpful through every part of a project's life cycle, from the early stages of iterating on the product, getting customer feedback so that they can reach product market fit, and then going to market with the right distribution channels, the right partners, until eventually there is a path to an exit, whether that is listing on an exchange, pursuing an M&A strategy, or eventually IPOing. So that really sums up sort of the ways that we try to bring our Pantera edge to our portfolio companies. I'll hand it over to Joey now to talk about how we generate alpha on the portfolio for our investors.
Thanks, Franklin. So one thing people often say to us is, why not just buy, Bitcoin or Ethereum? And I think there's a couple of responses that we would have to that. One is that, I don't think it makes sense to put all of your allocation to the space in one or even two assets. I think it's important to own a diversified portfolio. But I think the other reason is it's important to own exposure to kind of where the space is going next. And the way I would describe it to people is, if you think about the first 5 years of the space, you really wanted to own Bitcoin. The next 5 years of the space, you really wanted to own ETH. And I think the next 5 years of the space, you're going to really want to own a portfolio of DeFi protocols. I think that's where we're going to see the most growth in kind of terms of percentage ROI in the space over the next 5 years. And if you look at our fund performance, both year to date and since January 1, 2020, this has been playing out. So year to date, our early stage fund and our liquid token fund are both up, north of 300%. Bitcoin's up about 61%. And then since January 2020, our early stage fund is up about 2,399%. Our liquid token fund's up 1,553%, and Bitcoin's up about 540%. So you can kind of see, both from like an intuitive level, it makes sense to own more than just Bitcoin or ETH, but also from a performance standpoint, we think it makes sense as well. And then last, I'm going to pass it back to Dan to talk about our upcoming travel and to wrap up.
Thanks. And I want to make an analog to that slide that Joey just talked about, alpha coming from things other than Bitcoin. I spoke at the SALT conference last week, and some of my closest friends are Bitcoin maximalists that really love Bitcoin and just kind of have super passionate about it. And Bitcoin's been great. Our Bitcoin fund's up an amazing amount. Helped investors make literally billions of dollars and delivered 5 billion of profits back to LPs. So it's been amazing, but it's going to be hard for Bitcoin to go up 67,000% again, right? So it can go up a lot. Like I think Bitcoin can go up 10x or something like that. But these other projects can go up even more. And so we're very bullish on things outside of Bitcoin. And the analog would be, it's kind of like in the 90s, late 90s, saying the majority of tech profits were going to come from things other than Microsoft. Microsoft was already a really big company. It was worth 260 billion in 1998. At the time, Amazon was only 10 billion. Apple was only $1 billion in market cap. And Google and Facebook didn't even exist. They were zero. So over the next 20 years, Microsoft did great. It went up 10x, right? Like that's an awesome trade, but it was only 20% of the future profits of the industry. And that would be the perspective I would share here, is that I think things other than Bitcoin will be the majority of the profits. And in the last 6 months, things other than Bitcoin have actually been more than 100% of all the profits. Bitcoin's down since February, and other tokens have gathered 800 billion in market cap. All right, so the last slide is we are all vaccinated and believe in science, so it's time to get to see people again. And we are doing meetings in various cities around the world, obviously doing one-on-one meetings, but kind of more fun opportunity is hosting a lunch with people in your community that are also equally interested in blockchain. And so on our website, you can register for meetings in specific cities, or shoot an email to IR@Pantera Capital to register for these meetings. So we'd love to see you, and trying to help each of you think through how to get exposure to this space. And with that, I want to close the normal discussion and make sure we've answered most questions. There have been a handful that we've answered as we have gone along. And I'll try it. I'll take this first one on banning of Bitcoin. So Andrew Sarna does mention that China has banned Bitcoin 3 times already. And so in our first investor, I think it was April, after China announced the ban, I said I was dubious on whether they were really going to do it, because I've already seen it announced 3 times and they didn't actually do anything. And then I also posted a tweet that said investors who sell on China bans usually end up bummed, and it listed the returns since China banned various disruptive technologies like Google and Facebook, and then Bitcoin in 2013, Bitcoin in 2017. So China banning things is actually a very positive sign. It means something really big is happening, and that they're going to try and replicate that technology within their own country with the national champion owning the value rather than a foreign entity. That would have been neutral if they didn't then also shut down Bitcoin mining, which they have actually done, as I mentioned. So I think that means it's very positive, because there's at least a perception, I don't know if it's actually entirely true, that China was using dirty sources of power. Most of Bitcoin mining was actually done with hydro, but it's hard to prove that. So with China shutting down mining and mining going to countries where there is more data and it is provably renewable, I think it's great for our space. And with that, I'll hand it back to Joey in case he wants to answer a couple of these DeFi questions.
Awesome. Yeah, there's a couple of interesting questions here. One is about, what do we see with M&A and consolidation in the DeFi space? I think there'll be more of it going forward. There's a couple of DeFi protocols that are kind of have like token holder proposals to merge. I think we'll see more of that in the future, especially as all these DeFi protocols have larger and larger treasuries on chain. There's another question about proof of work and proof of stake. If proof of work miners have consolidated into large scale players, won't that occur in proof of stake? And doesn't that defeat the decentralized nature of blockchains? I think there's a couple of things here. One is that, with proof of stake, it's much easier to delegate to someone else than it is like with proof of work, where you have to host your miner somewhere. But even with proof of work, you can change the mining pool that you're pointing to. So I think the idea is that if someone ever did do anything malicious, you would just switch to a different pool. I don't see it being that big of a problem in practice. And then the other thing is that the whole idea of blockchains is that they're trustless. Like, you don't have to trust another party, but it doesn't necessarily mean that you have necessarily maximal decentralization. I think if there's 50 different options you can choose from for proof of stake, and then one of the options is also just running your own node, I think that's totally decentralized enough to not have any problems in practice. Then I think Dan has a couple of questions he wants to answer as well.
Yeah, I'll take the one on how regulation might impact the returns of early stage projects and the early stage token fund. So in our August letter, we listed the dozen or so big risks the industry faced. One of the last big ones was no regulated custodian. All those risks have been taken out, and really the last thing left is regulation, and very specifically within the SEC's purview. So all the other regulatory bodies in the US have ruled on blockchain, and it's always been the best possible ruling. And then most of those regulatory bodies and then the SEC have generally allowed the blockchain space to evolve. And even though the existing regulations from the Great Depression aren't really well suited, for distributed ledger technology. So that is the last risk, and it's something you can't hedge, or it's something you can't forecast. But one of the only things I worry about in our investing is waking up one day and finding out that the SEC's done some draconian policy, particularly against DeFi. Again, it's not our central case. We think they'll let everything evolve and grow, but it's just the one kind of unhedgeable existential risk that we just can't, or exogenous risk that we can't do anything about. And Joey, I want to see if you want to answer any more questions that are existing.
Yeah, let's see. There's one kind of final question, actually two final questions about DeFi that we'll answer, then I think we can wrap up. One is, how do we evaluate different smart contract platforms like Ethereum versus Cardano? Somebody asked how many people are building on top of each, and how do we think about allocating to smart contract platforms versus applications that run on top? I think there's a couple of thoughts I have here. One is, I think, not necessarily true over the short term, but over the long term time horizon, I think there's more value in investing in applications in terms of ROI than there is in the underlying protocols. With ETH in the hundreds of billions, Solana, 50 to 80 billion. All these protocols, all these kind of layer one protocols are getting quite expensive. I think they're going to go up more over time. But if you look at the applications, you can buy them, like orders of magnitude cheaper. In the application layer, well, sort of the application layer, like the protocols on top of the layer ones have really large usage numbers in DeFi. And so I think there's a better relative value there. And then if you look at, ETH versus Cardano or something like that, you can look at how many people are building on top of each of them. There's, again, orders of magnitude more people building on top of Ethereum. After Ethereum, you have probably Solana as the next most popular thing people are building on, and then maybe something like Polkadot. But after ETH and then Solana, everything else kind of below ETH, Solana, Dot, Cosmos, Near, like below those, it's a much shorter number. So like right now, for instance, we don't actually own any Cardano. And then the last question is on anonymous DeFi protocols and very decentralized projects like SushiSwap, and what are our thoughts on them? I mean, I think they're really interesting. It's really cool that you can have a decentralized exchange created by a bunch of like pseudonymous people around the globe that actually functions. It's actually like a really cool thing to see. As far as our thoughts on them, I mean, SushiSwap is an example of like we own that position in our liquid token fund. From like an early stage standpoint, we wouldn't invest in something with anonymous founders because like legally you can't do a private financing where you don't know who you're giving the money to. Like they could be on the OFAC list or something. But something that's publicly traded like SushiSwap, you don't really have that problem there. You can buy it on an exchange that doesn't have that issue. And so I think SushiSwap's really interesting and relatively undervalued in the market, which is why it's a position we have a strong position in right now. And with that, I think we've answered kind of all the main questions that people have. If you have any other questions, feel free to email us. If it's about investing, IR@Pantera Capital. If it's about something in the space, all of our emails at the firm are just our first name at panteracapital.com. And thank you, everyone.